Hello everyone, I am Dr. Manoj Kumar NV, working as an Associate Professor in the Department of Management Sciences, Maharaja Institute of Technology, Mysore. So today we are discussing about NBFCs, non-banking financial companies. The subject entitled Banking and Financial Services, subject code is 18 NBFM 301, and today we are highlighting on what is NBFCs and how the functions of NBFCs and how it is different from the banking functions. So these are the major things which we are going to discuss today. So shall we be looking to what is NBFC? A non-banking financial company is a company registered under Company Act 1956, engaged in business of loans and advances, acquisition of shares, stock, bonds, securities issued by the government or local authority or other marketable securities of a like nature, leasing, hire purchase, insurance businesses, check businesses, but does not include any institution whose principal business is that of agriculture activity, industrial activity, purchase or sale of any goods other than securities, or providing any services and sale, purchase, construction of immovable properties. These are all not fall under NBFCs. A non-banking institution which is a company and has principal business of receiving deposits. So here the main function of NBFC is to receiving deposits and under any schemes or arrangement of one lump sum or in installment by way of contribution or any other manner is also one of the major function of non-banking financial company. So in the non-banking financial company where we can consider that these financial activity as principal business. So why do we call it the non-banking financial services as principal business? This is one of the major feature of or characteristic of NBFC. So here the thing in the NBFCs, the financial activity as considered as a principal business is when the company financial asset constitute more than 50%. So more than 50% of company financial asset to the total assets. And when we consider the income from financial asset constitute more than financial asset income should be constitute more than 50% to their gross total income. So a company which fulfills both these criteria, first one is 50% of financial asset which is greater than 50 or more than 50% of financial assets out of the total assets, and these fixed financial assets should contribute greater than 50% when we take a consideration out of gross income. So a financial company which fulfills both these criteria will be registered as a NBFC. So therefore these two criteria are most important towards get the registration under the Company Act 1956. The term principal business is not defined by the RBI Act. The Reserve Bank has defined it so as to ensure that only companies predominantly engaged in the financial activity get registered with it and are regulated and supervised by it. So therefore, there is no regulation and supervision by the RBI with respect to principal business. Hence, if there are companies engaged in agricultural operation, industrial activity, or sale or construction of immovable property as their principal business and are doing some financial business in a small way, they will not be regulated by the Reserve Bank. So interestingly, this test is popularly known as 50-50 test. 50-50 test, and is applied to determine whether or not a company is into financial business. Then coming to NBFCs are doing functions similar to banks, and what we can able to find it as a difference between the banks and NBFCs. NBFCs lend and make investments, and hence their activities are akin to that of banks. However, there are few differences as given. The first one is NBFCs cannot accept demand deposits. So they can do receiving deposits, but they couldn't be able to accept the demand deposit. The second one is NBFCs do not form part of the payment and settlement system and cannot issue checks drawn on itself. So therefore, they don't have a right to issue the check, and they don't and they don't have a form of part as a function of payment and settlement system. And coming to the third one, where the deposit insurance facility of Deposit Insurance and Credit Guarantee Corporation is not available to the depositors of NBFCs, unlike in case of banks. So few banks are also considered as a NBFC, but those NBFC depends on these two criteria. Then we need to look into, is it necessary that every NBFC should be registered with RBI? So in terms of section 45 subsection 1A of RBI Act 1934, no non-banking financial company can commerce their business towards commencement or carry on businesses on a non-banking financial institutions without obtaining a certificate of registration from a bank and without having net owned funds of rupees 25 lakhs. So 2 crores since April 1999. However, in terms of power given to the bank, the obviate dual regulations, certain categories of NBFCs which are regulated by under the regulators are exempted from the requirement of registration with RBI. So venture capitalist fund, merchant bankers, stock broker companies registered with SEBI, insurance company holding a valid certificate of registration issued by IRDA, Nidhi companies are notified under the section 620(a) of the Company Act 1956, chit companies as defined in class B of section 2 of the Chit Fund Act 1982, housing finance companies regulated by National Housing Bank, stock exchange are mutual benefit companies. So therefore, even though they are registered under the different act, different incorporation they do, but they are not going to be registered in under the RBI. Then what kind of the procedure need to be fulfilled by the Reserve Bank for registration? So the applicant company is required to apply online and submit a physical copy of application along with the necessary documents to the regional office of the RBI. The applicants can be submitted online by accessing RBI secured website cosmos.rbi.org.in. At this stage, the applicant company will not need to log on to the Cosmos application, and hence users' IDs are not required. So the company can click button for company registration on the login page of Cosmos application. A window showing the Excel application form available for download would be displayed. The company can then download suitable application form, either NBFC or SC or RC scheduled company or registered company or NBFCs from the particular website, and key in the data and upload the application form. The company may not to indicate the correct name of the regional office in the field of C8 of the annexure 1 identification particulars in the Excel application form. The company could get the company application reference number. So this certification of registration application filled online. So thereafter the company has to submit the hard copy of the application form indicating online application reference number along with the supporting documents to the concerned regional office. The company can then check the status of the application from the above mentioned secured address by keying in the acknowledgement number. So therefore they can able to easily access and even they can able to verify it. Then we can look into what are all the requirements for registration with RBI. The first thing is we can look into it should be company registered under section 3 of the Company Act 1956, that is the mandate thing. So therefore any NBFCs, they must need to be incorporated as per the Company Act 1956, and the second criteria is it should have a minimum owned fund. So minimum owned fund should be had rupees 200 lakhs. So the minimum net owned fund required for the specialized NBFCs like NBFC Mutual Fund Investment Scheme, NBFC Factors, and in the FAQ frequently asked question on specialized NBFC. So therefore these two are mandate towards get the registration from the RBI. Then what are the systematically important for NBFCs? So NBFCs whose asset, the total asset for NBFCs should be, any NBFCs? They should have a total assets worth of rupees 500 CR or more as per last audited balance sheet are considered as systematically important for NBFCs. The rationale for such classification is that the activities of such NBFCs will have a bearing on financial stability of the overall economy. So therefore, they must need to be take a consideration of the total assets. So therefore, the total assets should be 500 crores or more than that. Then once they finalize the total asset, then they must need to think about, does the Reserve Bank regulate all the financial companies? So number of housing finance companies, merchant bankers, stock exchanges, companies engaged in the business of stock broking or sub-broking, venture capitalist companies, nidhi companies, insurance companies or chit funds are NBFCs. But they have been exempted from the requirement of registration under the section 45 subsection 1A of the RBI Act 1934 subject to the certain conditions. The first condition is to all these such companies from housing finance company, stock brokerage, merchant banker, chit fund owners, they are regulated by Security Exchange Board of India, and insurance companies are regulated under IRDA, and chit funds fall under the Chit Fund Company Act. So therefore, these are the affairs are regulated by the company or corporate affairs government of India. So therefore, these companies do financial business but are regulated by other regulators, are given a specific exception by the RBI from its regulatory requirements for avoiding duality of regulation. So therefore, to avoid such duality of regulation, they make only with respect to the pertaining field like mutual funds or housing board of finance or chit funds, merchant bankers, they have their own separate regulatory body. In under that, they are going to be registered rather than they are going to be registered again once again in under RBI. It may also be mentioned that mortgage guarantee corporations or companies have been notified as non-banking financial companies under section 45 subsection 1 and subsection 3 of the RBI Act 1934. Core investment companies with asset size of less than 100 crores and those with asset size which is less than 100 crores and above but not accessing the public funds are exempted from the registration with RBI. So this is also one of the condition as per the 1934 of RBI Act where they clearly state that whatever the investment of core investment company should not be 100 crores or less than 100 crores, and whatever they have 100 crores, it should not be from the public funds. So then also there is no need of registration with RBI. They can able to considered as NBFC. So therefore, even though the small amount that less than 100 crores, even that they can able to register under the particular act. Then what are all the different types of NBFCs or categories of NBFCs registered with RBI? So NBFCs are categorized, and the first condition is to in terms of the type of liability into deposit and non-deposit accepting NBFCs. The second type is, the first type is deposit and non-deposit accepting NBFCs. The second one is non-deposit taking NBFCs. Non-deposit NBFCs, we also call it as NDS, non-deposit holding companies. And the last category in under the NBFC is kind of activity. So based on activity based. So the first category where in terms of the type of the liability into deposit and non-deposit accepting NBFC. The second category is non-deposit taking NBFC by their size into systematically important and other non-deposit holding companies. As I said, NBFC or NDSI, we call it as. And the last category is by the kind of activity they conduct. Within this broad categorization, the different types of NBFCs are available. So we will look into one by one. So the first one under this is AFC. AFC, where we call it as asset finance companies. So an asset finance company is a company which is a financial institutions carrying on as its principal business the financing of physical assets supporting productive economic activity such as automobiles, tractors, lathe machines, generator sets, earth moving and material handling equipments, moving on own power and general purpose industry machines. So principal businesses for the purpose is defined as aggregate of financing real physical assets supporting economic activity and income arising therefrom is not less than 60% of total assets. So the income should be 60% of total assets supporting to the economy, as well as the income which is greater than 60% of total asset and income respectively. And coming to the second type, that is IC, we call it as investment companies. So investment company means the name only indicates those companies which is considered as a financial institution carrying on as its principal business the acquisition of securities. So therefore they mainly concentrate on investing on securities, and by that they are going to make a profits. And the third one is loan companies. Loan company means the company which is a financial institution carrying on as its principal business by providing of finance, whether by making loans or advances or otherwise for any activity other than its own, but does not include any financial finance company. So therefore they should not provide the loans for purchasing the asset. Instead of that, for anybody, if they are providing the loans or advances, then they are going to be considered as a loan company. Then infrastructure finance company, IFC. Infrastructure finance company is also considered as a non-banking finance company in which deploys at least 75% of its total assets for infrastructure loans. So therefore they are going to be contribute 75% of their total assets to provide the infrastructure loans, and has minimum it's have a net owned funds of rupees 300 crores. So therefore, they should have a 300 crores of net worth, and by that they must need to be provide 75% for that too for the purpose of infrastructure finance, and it should have a credit rating A or equivalent and have a CRAR credit rating with respect to 15%. So they should need to be have a credit rating of 15%, and they should have a credit rating A grade. So these are the things which is required for investment finance companies. Then we will move into the next category. The next category is fifth one, where we have a systematically important. Systematically important core investment company. Important core investment companies. So where in under systematically important core investment companies is an NBFC carrying on their businesses for acquisition of shares and securities which satisfy the following terms and conditions. So they must need to be fulfill all the 6 conditions. The first condition is it should need to hold not less than 90% of total assets in the form of investment in equity shares. So they must need to have out of total assets 90% should need to be invested on equity shares or preference shares or debt or loan in group of companies. And coming to the second one, where it should be have an investment in the equity shares including all the instruments like compulsory convertible into equity shares within a period not exceeding 10 years from the date of issue. In group companies constitute not less than 60% of its total assets. Then coming to the third criteria, where it does not trade in its investment in shares or debt or loans in group companies except though through a block sale for a purpose of dilution or divestment or disinvestment. And the fourth condition is it does not carry on any other financial activity referred to in the section 45C and 45F of the RBI Act 1934 except investment in bank deposit, money market instruments, government securities, loans to and instruments in debt issuances of group companies or guarantees issued on behalf of group companies. So these are all the things they must need to be taken into consideration. And the fifth one is asset size. The total asset size should be more than 100 crores, and the last one it can be accept the public funds. So these are the 6 criteria should need to be followed under the systematically important core investment companies. Here majorly they are concentrating on investing on equity shares, where when they are investing on equity shares, there they must need to be have a 90% of the investment should need to be made it on equity shares out of the total assets, and they should have a 10 years continuous perpetuality for the investment. At that time they can have a 60% of their total assets they can invest it on the particular convertible into equity shares. And even they should not need to trade the shares, debt, bonds, loans and all, but they are going to be get the exception with respect to dilution or disinvestment. Then coming to the 6th one, where we have a infrastructure debt fund. So infrastructure debt fund means where this is also one of the NBFC, where here they are going to be registered under the NBFC to facilitate the flow of long-term debt into infrastructure projects. So here they raise the resources through issue of rupee or dollar denominated bonds of minimum 5 years maturity. Only infrastructure finance companies can sponsor for infrastructure debt fund. So therefore this is not available for public. If the companies are bankers who are ready to do the finance, then they can able to invest it on infrastructure debt finance. Then we have a seventh one, non-banking financial company. So non-banking financial company, it's like it's almost they are planning to provide the funds to the public, where we also call it as microfinance institutions. So microfinance institution is on non-deposit taking NBFC having not less than 85% of its assets. So therefore here also 85% of the assets should need to be provided for the public, and in the nature of qualifying assets which satisfy the following criteria. The first criteria is to loan disbursed by an NBFC through a microfinance institution to the borrower with a rural household annual income not exceeding rupees 1 lakh, or urban or semi-urban household income not exceeding 1,60,000. So therefore the purpose is to reaching each and every public. And the second thing is the loan amount should not exceed rupees 50,000 in the first cycle and in the rupees 1 lakh in the subsequent cycles. And the third should be total indebtedness of the borrower does not exceed rupees 1 lakh, and tenure of the loan not to be less than 24 months. So therefore everybody they can get the 2 years of the loan in excess of 15,000 rupees 15,000 with the prepayment without penalty. So therefore only the interest which is going to be charged is 15,000 without having any penalty when they are fulfill the return back the amount within the stipulated date. And the loan is to be extended without collateral. So therefore even though you are not providing the collateral securities, even the amount you can able to raise, it depends on the repayment ability. Aggregate amount of loans given for the income generation should not be less than 50% of the total loans given by microfinance institution. And the lastly, loan is repayable on weekly, fortnightly or monthly installment at the choice of the borrower. So therefore it depends on the borrower's interest, whether based on his ability to have a repayment, based on that it is going to be decided. And coming to the next one is NBFC factor. So NBFC factor, where the factor is a non-deposit taking NBFC engaged in the principal business of factoring. So the financial assets in the factoring business should constitute at least 50% of the total assets. So therefore should have a 50% of the contribution should made it on the particular purpose. Assets in the factoring business should constitute at least 50% on its total assets, and its income derived from the factoring business should not be less than 50% of its GTI, gross total income. So therefore factoring, as you know, whatever we are expected to receive from the debtors, the banker, the NBFCs, they are agree to pay to us, and they are going to be collect from the debtors, so with the risk. So therefore most of the companies, they are hand over their responsibility through the NBFC So therefore they collect the amount whatever the requirement or immediate commitment they want to fulfill it. So therefore they are hand over the responsibility to the NBFCs. So the NBFCs, they are going to be collect from the respected debtors. Then coming to the ninth one, where we have a mortgage guarantee companies. Mortgage guarantee companies. So this is also one of the financial institution for which at least 90% of the turnover of the business turnover should be meet in the mortgage guarantee business, or at least 90% of the gross income should be rise from the mortgage guarantee business, and owned a minimum of 100 crores owners funds or 100 crores net worth. Then we have the last one, the 10th one, where we have a NBFCs on non-operative financial holding companies. Non-operating financial holding companies. So these also considered to be a financial institution, non-banking financial institution, through which the promoter or promoter groups will be permitted to set up a new bank. It's a wholly owned and a non-operative financial holding company which will hold the bank as well as other financial services companies regulated by RBI or other financial sectors regulators to the extent permissible under the applicable regulatory permissions. Then we also look into what are all the powers of RBI with regard to NBFCs, that is companies that meet 50-50 principal business criteria. So the RBI has given the power under the RBI Act 1934 to the register, lay down policy, issue direction, inspect, regulate, supervise and exercise surveillance over NBFCs that meet 50-50 criteria. So of principal business, the RBI can penalize NBFCs for violating the provisions of RBI Act or the directives or orders issued by the RBI under RBI Act. The panel action can also result in RBI cancelling the certificate of registration issued to the NBFC or prohibiting them from accepting deposit and alienating their assets or filing winding up petition. They are going to be provided for the NBFCs who are not going to fulfill the criteria of RBI Act. So when we look into the overview of NBFCs, so these NBFCs under the company, as I said, it is fall under the Company Act 1956. So in under that the NBFC registered with RBI and NBFCs regulated by other regulators and NBFCs and non-financial companies. So when we take a consideration of registration under the RBI, there will be a regulation, there will be a supervision and surveillance and enforcement under the RBI Act. All these things which will be applicable for NBFCs. When we take in consideration of second category where NBFC regulated by other regulators, like if you take an example of financial institution like House Finance Corporation, then it is going to be take a regulatory body under National Housing Bank. If you take a consideration of merchant banker, venture capitalist funders or stockbrokers, collective investment schemes, then they are fall under the SEBI because they are mainly concentrate on the security investment. And Nidhi companies, mutual benefit companies, they are concentrating on MCA. And chit fund corporation, they are fall under state government. and insurance company they are following their IRDA, Insurance Regulatory and Development Authority. So these are the regulatory body where the other regulators other than RBI they are going to control the NBFCs. Then coming to NBFCs, non-banking and non-financial companies, then the regulation, supervision and surveillance and under the Company Act 1956, and also there will be regulators like Ministry of Corporate Affairs. They are going to take the control of entire business because they are following the Company Act 1956. So and even it is enforcement agency will be a state government. This is the entire overview of the how the regulators which is they are going to be controlled on, they have a control on the particular NBFCs. Then coming to the advantages of NBFCs, when we look into the advantages, the first thing is as an NBFC they have a permission to provide the loans and credit facilities. The second one is they can go for trade in money market instruments, and they can do wealth management such as managing portfolio of stocks and shares, and also they can underwrite the stocks, shares and their obligations. NBFCs are the last resorts of borrowings. NBFCs are where bank are not there. So means whenever the banker is not ready to give loans or advances, then there will be a supporting body as a last resort. NBFCs are there. NBFCs are the largest propellants of sharing finance into the country, and agility is very important for NBFCs as it sets the bank apart, bank function slower as compared to NBFCs. The use of modern methods by NBFCs has overcome key challenges. They had overwhelmed conventional lending. NBFCs have made a great usage of technological advancement like the use of mobile phones and the internet which has helped in making information easily accessible anytime, anywhere. It has reduced the demand and reliance on bank branches. And when we take a consideration of technology, it is not only at the head of banking and financial services, but also an increasingly digitalized India has underpinned the rise of NBFCs. Digitalization has given NBFCs the ability to present multiple choices and reach the larger audience at quicker pace. This indirectly gives a rise of larger NBFCs, and combination of partnership and database helps in the increasing penetration of financial inclusion to reach large number of customers successfully and minimize the risk. NBFCs have forged partnership including the government to use their database and identify the customer worthiness, and the lending has become productive. And coming to the disadvantages, NBFC cannot accept demand draft as it falls within the realm of activity of commercial banks, so because there is a banker function. And the second one is an NBFC is not a part of the payment and settlement, and as such as an NBFC cannot issue check drawn on itself. And the third one is deposit insurance facility is not available for NBFC depositors unlike in case of banks. The fourth one is all NBFCs cannot deposit, only some can. Only those NBFCs including valid certificate of registration with authorization to accept public deposit can accept or hold public deposits. And the last one is the regulatory mechanism for NBFC is stringent. So this is about the whole clarity on we have a light on the NBFC. So today we are discuss about what is NBFC, how the registration process of NBFC, what are all the different types of NBFC, and what will be the criteria which is needed to get the registration from RBI and the other boards, statutory boards. And we also discuss about the different types of NBFCs and advantages and disadvantages. Hope it's reached to you. Thank you for your listening. Thank you one and all.